Well, hello everyone. Welcome to After the Close. My name is Barbara Armstrong. I'm a coach and senior manager with Charles Schwab, and delighted that you guys are joining me here today. The bell has rung, the trading day is over, and the premise of this account is that we have some money we'd like to invest and create a portfolio with, $1 million. That's what we started with. And we're looking to build a portfolio that doesn't require us being attentive during the trading day. So we're looking at, if you have a full-time job and a household, and when you're done your job, you're, trying to, get kids to soccer and lacrosse, in between getting the lawn cut and throwing some meals at people, and you get to sit down at 8 o'clock at night, how might you approach trading in the markets? And thus far, we've been trying to build a portfolio. We're going to look starting next week at some income generating strategies. And we've talked a little bit about that, but today we've got some trade management to do. We've got some new trades to place. We want to look at sector rotation because those sectors, they've been a rotating, and we have some gaps in our portfolio. So we're going to look at that today as well. If you are not following me on X, I formally invite you to do so. My handle at Barb Armstrong CS. We also have Mike Fairborn with us in the chat. He's an excellent coach and a great guy, and you'll want to follow Mike as well. His handle, Mike Fairborn CS. And then to all of you who helped bring this class to life, to John the Noble Savage, who was the first one in, and Kevin, and Life in the Fast Lane. I love some of these handles. You guys are really creative. And Scott and Will and Sharon and the rest of the gang, thank you all for being here. So just before we get into the thick of things, know that everything that we discuss in this class is for general information purposes only, none of it to be construed as a recommendation. While we look at charts and technical analysis, other approaches, including fundamental analysis, we're in the midst of earnings season, so being aware of what's going on in earnings, in the news, and then globally with respect to, economics and trading. And of course, there's been a lot of tariff discussion and how that might impact not only our economy, but individual stocks as well. So it behooves us to be able to make a more informed decision to look at all of that, right? Right. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to learn. We'll talk about some of the things that are different between that and a live account as we go through. But just know that this is where all our example trades are placed. If you have never been to a live event, you may want to consider checking it out. When I came into this business as a client who was introduced to all of this through a live event, I continue to be a big fan of live events as a coach. So, coming up in May, we have an advanced options event, a 2-day workshop in Anaheim. I will be there along with Mr. Ben Watson, who will be leading the charge on that. And then we've got an event clear across the other side of the country in Miami in June, and Kevin Horner and Ben Watson will be there, along with a cast, drawn from all over the country. So, these are really great events, and they're free for you to attend. There's no registration fee. We'll provide breakfast and lunch, and at these market drives, a nice reception afterwards. And then at the end of June, there's another event at the Marriott Marquis in the heart of Times Square in New York. And I will be at that event with bells on. So I hope you can join us for some of those. The registration is easy. You just want to go to, let me just bring this up. You want to come to schwab.com/coaching. And when you get here, you're going to come to these in-person events. And then you can just click on this link to learn more and register if you're so inclined. The one thing I'd encourage you to do is, we've made these as large as we can, but there is a limit to how big a facility that we have access to. And so I'd encourage you to register sooner rather than later for these. And then if you're interested, you're new to these webcasts and you want to see, what else is available, this is the whole schedule for our day-to-day webcasts. And if there's a particular coach where you're looking for their classes, like Mike Fairborn, you can just kind of scroll down here. They're listed in alphabetical order by first name, and you can see the classes that he teaches on a regular basis. Swing trading on Tuesdays. He does a great market and sector analysis class on Wednesdays. And then he has quite a following on this Think Script class on Fridays as well. Okay, so that's that. Let's come out to the platform now and have a look. And we're going to make this pretty quick because Kevin Horner does a wonderful job with Trader Talks at the beginning of the trading day. But when we look at the S&P 500 after, pulling into a bear market territory, I just lost my, come to mama. Sec. My mouse decided to take a short vacation. Let me just plug it back in again. The S&P 500 was actually in correction, not only correction territory, but bear market territory, and it's come a long way back. Now, it's still not back above the 100-day moving average, but we've seen this series of bull flags coming, right? Right. Which is pretty encouraging. And then if we come to the NASDAQ, similar type of pattern, right? And we're looking, this 100-day moving average kind of coincides with this previous support level here. And might that, in fact, end up acting as new resistance? Not sure. Some might say, well, why did you draw your line there? Okay. I don't know why my mouse, just give me a second here. This is going to be let me plug it into a different port and see if it'll work. This is weird. Sorry, guys. That. Yeah. There we are. Okay. It's back. Sorry, I just had a little technical hiccup there. So some might say, you drew your line based on this previous support level. I'm kind of thinking this is a more appropriate line. And that's the beauty of technical analysis, is there's lots of ways, to look at things, right? And so we had a high here, came up to a similar high, and today, was poking at it again. So we'll just see. But, from this bottom, I change my drawing tool here. That's a 22% rally. Pretty significant, isn't it? But you have to keep in mind, like if you look at this, like how far of a pullback was this? You're saying, well, that was 25%. If we rallied 23, but if you have a 50% drop in the market, if you go from 100 to 50, you have to then grow by 100% to get back to where you were. And so sometimes these numbers can be a little misleading. We still have a fair ways to go, to get back to where we were on February 19th. But things are, coming back around the bend. Now, when we look at volatility, which is some might say our fear index, at 22, it's come down a long way, but we're still a long way, we're still higher than we've been. So if I take this line and move it up to here, most of the last year we've spent below this 22 level. So, there's still uncertainty in the market. Okay. Now, if we look at the sectors, and, here's our description on these. And when we look at the last 3 months, utilities, consumer staples, and now industrials are the top 3. And when you look at our example portfolio, what do we have a lot of? Utilities, consumer staples, and communications, which have also been strong. And then we've got one in industrials here. That's been in the top three. Consumer, a lot of consumer staples. And then McDonald's, it's in the consumer discretionary category. Sadly, there are some people that, along with Coca-Cola, might consider, that to be a staple. I don't get to pick which groups these go into, my friends. Like, I'm just reporting. But when we look at, utilities and consumer staples were the top two. And now, which are the top two in the last month? Technology and industrials. And how many tech stocks do we currently have? Almost none. And financials, which has really been, making some headway. How many financial stocks do we have? Almost none. None, actually, not almost none. We have nothing in tech, nothing in financials, and one stock in the consumer discretionary sector. So as we continue to build, we might say, well, maybe these are sections where we want these are sectors where we want to do a little bit of looking. Now, one thing we do want to do is make sure we're managing what we have. And so let's come down and look at, we placed a trade on, I think it was Dollar Tree last week, because it was breaking out. And that's one of those in that consumer staples category. And so that's just kind of rolling along. I think we put a target on that. But what I want us to look at here is some of these, and McDonald's is one of them. So McDonald's, it looks like we're underwater on. Today it went down. So, and we had this in our callers group. So what that tells me is that at one point we had a caller on this. Now it's showing we're net down by $219. Okay. So let's come and look at what we done on McDonald's. So back in March, we bought 100 shares of stock and we sold a covered call and then bought a protective put. And so if we don't consider the price of the stock here, we had, just let me grab my drawing tool. So we sold that call for $660. Oops. I was just recording a short video. So you have to look on X that, after this class, there will be a short video there for your viewing pleasure. So we sold that call for $660. Oh, my drawing tool's acting up. And then we paid $237. We spent $237 of it to buy the protective put, which ended up expiring worthless. So net on this, we were ahead by $423. And then this call, we rolled it. So we bought back this call that we sold for $660, and then we sold a new call, the May 325 call, for $370. So we added another $370 to our coffers for a total of $793. And then we bought back that covered call for $295 to take the potential of being called out off the table. And so the net of it was we ended up here at $498. So that's not showing when we look at our position, this $498. So we're actually up by a little bit. Okay, so what might we do? Because we don't have a covered call on this now. Let's go out and look at the chart. So if we come and we look at the chart for Mickey D's, well, it was uptrending. We had this kind of double bottom pattern. We bought in here. And what was the logic there? Well, we had seen it consolidate and then come back and retest twice and look like it was going up. Now, in this class, we always put the orders in here and then they get filled the next morning. And so it really went up, but it's been kind of trading in a range, and it keeps coming back and hitting its head where? At this 320 level. So at this 320 level, and today it kind of pulled back. So we could say, hey, maybe if when we bought it, we were okay with selling a covered call at 320, maybe we sell another covered call. And this protective put on April 18th, that expired worthless. So we can leave that line on, but the protective put is gone. But could we sell another covered call? We're on the other side of earnings. And so let's come here and look out to June and say, if we sold that 320, we could make another $5, which is the net of basically we've made $4.98 so far in selling covered calls, less the protective put. So let's look at selling another covered call. And so we'd make somewhere between 490 and 505. And then in the morning, we'll just want to look and see maybe we could get 495 for that. We may just want to look and make sure that this order goes in. And so we're going to then put this in. Do we have a covered call? I'll put this in, let this go back into the callers group, and then we'll move it and we'll create a covered call group. So that's McDonald's. Okay. Now, what about Kroger? Well, what about Kroger? Let's come back here. So here's another one in this caller group, and we still have 7 calls. So we have the 75 call. We sold them for 68. They're now worth 10 cents. So we've got, what's 10 divided by 68 divided by 68? We've got 85% of our max gain out of those calls that we sold. And so, might we want to roll those calls? Well, let's again come and look at the chart. So when we come and look at Kroger, so this has come up now a couple of times, if you notice. And if you haven't, this is why I'm here and drawing this out. Like, it's trying to teach you how to look and notice things on the charts, right? So when we look at this, it's come up to around the 73 twice now and is pulling back. So might this have been a good time to sell a covered call? Well, it might be, not a bad time. Yesterday would have been better, but we weren't talking about this account yesterday. So could we come to the trade tab and look at taking our May call and rolling it out to June? And what would we get for that? Well, if we buy it back, we're going to get about 10 cents. It's going to cost us about 10 cents. And then, if we roll it out to the 75 call in June, we could get another $1.25 to $1.40. And so if we look at that, we say, yeah, that's like almost 2%, of this 75 level. So if we come to our monitor tab, how would we facilitate that? Well, we're going to right click on this trade and we're going to create a rolling order. And it's to buy back the call that we currently have on. And then we're not going to sell the May 23rd. We're going to come out to June. And we're looking at a credit of about $1.23. So one was the example, that was McDonald's, of placing a new covered call because the other one we had bought back prior. And this one is an example of rolling our covered call. Okay. Now, door number 3 is Altria. And Altria is a dividend stock that we had protected with a caller. So I guess I should have moved it to the caller group. And we have a 60 call. It's actually trading in the money. Isn't that interesting? And yet it's lost some value since we sold that call. And so we're still up just a smidge on that. The protective put is worth basically nothing. So let's go and look at the chart and see what we're looking at. Okay, so when we look at this, so this is when we bought the stock originally. We had this kind of cup and handle or double bottom pattern. It had broken out. It's, one of those things when people are stressed, if they smoke, might they smoke more? And, is it, it's considered a staple. It's in the staple category, which was strong. So we bought it and, it was kind of rolling along, doing well. And then we decided here prior to earnings that we would protect the position by collaring it and selling a covered call and then buying a protective put. And it's pulled back today, but this could be the beginning of the pullback, or it could be the end because it's come back to this old resistance. Might that be new support? And so we could just wait. And over the weekend, there could be more time decay and talk about this again next week. Or we could say, you know what? I could see this continuing to go up and I'd like to buy back the call to avoid the possibility of being called out because I would like to continue to own the shares. Now, if you don't want to continue to own the shares, you might just kind of let the chips fall where they may. And, we have a profit on this. Let me just, we're up about 10% on this position. Even with the pullback today, taking 400, about 10% out of that. But, so what we're going to do is look at our call. We'll let the put expire worthless and we'll look at buying that back. Or we could look at rolling it out further. Oh, actually, let's look at that. So like if we came out here, we have a call at 60. Could we come out to June and maybe do the 62? Let's look at that. So if we look at this, buying back 90, we come out to the 62.50, we'd only get 58 to 66 cents for the 62.50. Yeah, not worth it. But if we rolled it out to the 60, we'd get another 60 or 70 cents. We're just going to look at buying that one back. So we're going to right click. But, that's the thought process we go through, right? So we're creating a closing order to buy it back. And hopefully around 95 cents. Confirm and send. There we go. Okay, so that's Altria. Now let's look at some new opportunities. Yeah, somebody's asking if these are recorded. Yeah, they are. And then they're then available in the archives. And I'll show you, let's just place a new trade and then we can, I'll show you where to find those. And Mike might post a link to this playlist in the chat also. And I will also put a link in at the end of this webcast if you are watching this in the archives. But let's come and look at some of the financials. So, and we've talked about these in some of the other classes this week too. But, we look at Visa. And it's, I've been jokingly saying this is what the cool kids are doing. These diagonal resistance breakouts, we're seeing them, all over the place. So it's, and what we want to be sure is that it's actually a breakout, not a fake out, because sometimes it'll cross the river and come back and test the ice and it'll fall back through. And we've seen lots of that too. But, this has crossed the river, pulled back, went up again, 1 day pullback, moving to the upside. And, so if we look at this and we say, well, I wouldn't mind having this in my portfolio, or we could look at MasterCard. Do you see a theme here? Kind of the similar, right? Like broke out, 1 day pullback, came up. And then you might say, well, which one has maybe the more attractive price earnings ratio? Visa, like if we look at Visa, it's around 35, pays a small dividend. MasterCard, 39, pays a small dividend. How about American Express? Well, this one, price earnings ratio of 20, which puts it in the value category, Doesn't pay a huge dividend, but it's, over 1%, which beats the other two. So how does that chart look? Kind of similar, right? Like again, so if you're saying, well, I have three that are similar, how do I pick? And I mean, you may want to go and look at their, a lot of their other fundamental characteristics, but, it came over one day, pull back, came up one day, pull back, moving to the upside again, up 2.69% today. And so if we said, we'd be okay. And the other thing that I like about this one, and again, the others are similar, but not quite there. We drew a diagonal line, but if we look at this previous high and it came up and it hung out here for 3 or 4 days, and today it's breaking out that way also. And so where might you put a stop? Well, you might say, hey, here was a recent low here around 273.61. So if I look at that 273.61 and we knock 3% off that, now you may want to make it 2% or 1%. I'm just using 3% as an example. That would be 265.40 would be our stop. And so how much are we risking per share? If our stop is at 265.40 and, we're buying around this 283.66, I'm going to switch this to a calculator. So let's call it 284, just to use round numbers, minus 265. So we're risking about $19 a share. And in this class, we're willing to risk up to $5,000, which is half of 1%. So if we could risk $5,000, how many shares could we buy? Well, if we looked at 5,000 divided by 19, that's about 263 shares. Okay, so from a max risk perspective, we could buy 263 shares, but from a position size perspective, we didn't want any one position to be more than 5%, which is 50,000. And so, maybe what we do if we want to preserve our ability to sell covered calls is just buy 100 shares. Because 200 shares would be 56,000. Okay. So yeah, thanks, Mike, for posting that link to the playlist. So we are going to look at buying 100 shares and we're going to buy custom with a stop. And our stop, we're going to put at 265.40. 265.40. And what's one of the reasons that we're adding, this particular stock? Well, one, it's in that value category. It does pay a dividend. We're really, this isn't the main reason for our purchase. We're looking at diversifying, and this is in the financial sector. So we're going to put that in our growth stock group. And away we go. And we'll make sure that fills tomorrow. So that was American Express. And then let's look at Cognizant Technology. So CTSH. Now, why might I have picked a company like this? Well, one, it's in the green year to date, which is, not something that every tech stock can say. Two, I want to do my line this way. We've got, like I said, what all the cool kids are doing, we've got a diagonal resistance breakout. We're on the other side of earnings, and this beat on earnings, and we saw that it gapped up after earnings. And now this one is also above that 100-day moving average, along with being above the 30. And, if we may want to come and look at, some of the news on this, so how are analysts viewing this? And it's interesting. So raising price target to 88, well, that's way up here. It's down at 79. Now here they're raising the price target to 79. So go figure, raising the price target to 90, to 82, to 94. But it seems that they're all raising their price target, which is pretty bullish. Now, where will it go? Who knows? And who's right? And there's no knowing who's right. And in fact, the stock may not continue to go up at all, but because it ranges from 79 to 90, which is where the current price is. And here's 90, the previous high. But you know, the analysts who look at this stock tend to be pretty bullish on it. And so, you know, this doesn't mean that we only want to do what the analysts are blessing, but in addition, you know, if we came and we looked at the Analyze tab, we might just want to look, you know, it is in the tech sector. And we look at, you know, earnings per share has grown over the last 5 years from 257 to 451. Sales, you know, gone up modestly, but gone up from 30 to 39, you know, and just looking at some of these metrics, they've continued to raise their dividend. The book values continued to go up. Now, does this mean that all of this is going to continue to happen? Absolutely not. Next year, their numbers could be tanking. And when we look at their current price earnings ratio being 16, as opposed to the 5-year average of 19, that might indicate that, you know, it might be a good value. And again, no guarantee that that's, you know, going to continue to go up. And one of the differences too, you know, between a paper money account and a live account is that dividends are actually not paid in a paper money account, and they are paid in a live account, but there's no guarantee that a dividend will continue. Also, when we look at selling covered calls and buying them back and all of that, when you sell a covered call, you can be called out at any time from the time you place the trade until you buy it back, regardless of how much it's in the money. Now, the further it is in the money, the higher the likelihood that you may be called out. But even if it's way in the money, you might not be called out until expiration. And if you carry it into expiration and it's in the money, then the probability is very high that you will no longer own that stock. But, you know, and that's one of the differences. In paper money, you'll never be called out early on a covered call. Okay, so we're going to add some Cognizant to our account also. And if we go through a similar exercise for position sizing, we said, well, hey, you know what? I kind of see, and it, you know what? Sometimes people are nervous and they don't want to lose money. So they want their stop to be really snug, is how I describe it. But if we come down here, so you could say, well, I see that it gapped up here. Sometimes that's a support level. You might say, I'd rather go below this 76, 77 level. But if we look at 75.20 times 0.97, and we put our stop at 72.94. So stop at 72.94. You're saying, well, what's the probability that I might be called out? And I like the way you're thinking. So let's come to the trade tab and we're going to look at options for June. So if I look at this 72.50, the probability of it being below 72.50 is about 18%. And you have a 35% chance that it could come and kiss it, which means you've got a 65% chance that at 72.50, you won't be stopped out. If you made your stop closer to the 77 level, now you've got a 40% chance of it being in the money at expiration. And you've got almost an 80% chance of it kissing it. And when it comes down and gives it a smooch, you know what happens? It triggers a sell order. And now you're out. So you kind of, it's like my dad said, having teenagers, you want to give it enough room to grow without enough rope to hang itself. And so what we're trying to do is, if it does this again, we want to be out. But we don't want to be out necessarily if it just has a little pullback like this and then continues on up. And so it's kind of a delicate balance, right? Yeah. Okay. So we're going to put our stop here. And if we're getting in at 79.21 and our stop is at 72.94, again, we're going to get the calculator. 79.21 minus, let's call it 73. 621. So if we're willing to risk 5 grand divided by 621, how many shares could we buy? 805. Woo! Okay, so we can buy 805, but now if we only, we don't want to have more than a 50,000 position. So 50,000 divided by, let's call it 80. So we can buy, let's say 600 shares. Okay, so we're going to buy 600 shares. That'll check both those boxes. And we're buying with a stop. And our stop, now this closing price, you see, this is a really wide bid-ask spread. And that's because this stock is not heavily traded in the after hours. And so we're going to put this back to 79.21. We'll make it 79.30. And then for our entry and then our exit, 72.94. And how many shares did I say? 600. And then I'm going to turn this firecracker into a paper clip. I know, I have magical skills. Confirm and send. Oh, we want this to be good till canceled. So we want to buy 600 shares of Cognizant Technology. We're risking $6.36 a share. That's where our stop is. And if it gapped down, could we end up out with a bigger loss? Yes, we could. Yeah. And so we're putting this in our growth stock group. Now, could we put a target on it? Sure. Could we put this in our dividend category? Sure. You can put it wherever you like. And could we put a target on it? Say, hey, if it comes back up to 90, we'd like to sell. We could do that too. Or we could say, hey, we'd like to put an alert on here when it gets back up close to that high around 90. Do we stay or maybe sell a covered call? Sell or sell a covered call? Do any of those things. And that's just a reminder that, we have choices along the way, right? Right. Is there a class that teaches about how to read the earnings report and guidance? Mike, maybe you could answer that one. What you may do, and I said I would show you guys, and we just have a few minutes left. So let's come over to Trader Talks. And this is where you're going to want to subscribe to the channel, the Trader Talks from Schwab Coaching. There's a button down in the bottom right corner of your screen. And what will come up is whatever's currently playing. And then if you go to playlists and scroll down and look for after the close, you'll see, this playlist. But if you want to find out something about earnings reports, you could just type that in. And you can just scroll through and see if, one of these, economic data and earnings impacting the market. So see if any of these appeal to you. Or you might just say, like, I want something on fundamentals, which is what this topic is. Understanding earnings reports and understanding fundamentals. Yeah. So that gives you an idea of kind of where to look. Okay, so we didn't get to place all the trades. We never get to do everything that I'd like to do, but we got to cover quite a bit. And so just to review, we um, we did a trade on McDonald's, on Kroger, and on Altria, ticker symbol MO. So MCD, KR, and MO, we were managing our calls, our covered calls on those. We did a new trade on American Express that we teed up. And then we did one on Cognizant Technologies, or CTSH. So not bad for 45 minutes. So just as we wrap up, what I'd ask of you is that if you could hit the like button, it will help move this up in the trading algorithm so more people can find this content on YouTube. And then if you'd hit the subscribe button, if you haven't already done that. Last but not least, if you would follow Mike and I in the land of X, we would love to see you there. My handle, Barb Armstrong CS, and Mike's is Mike Fairborn CS. So my thanks to the production team behind the scenes that helps bring this class to life, to Mike Fairborn for answering all those questions in the chat, and to all of you for being here and for asking those questions. It's great to see. Have a really great rest of your day. This is the end of our live webcast for today. Tonight, Ben Watson at 7 p.m. Eastern is teaching along with Ray Kimbrell an advanced options virtual workshop. This will be the last in that 4-day series. So you're welcome to tune into that. And then we'll be back tomorrow with another full day of programming. So thanks for joining us. Have a great evening. Bye for now.